So the Fed cut rates by 1/4%. So how does this actually impact buyers and sellers out there? But first, I actually want to look at how that cut actually affected mortgage rates. Like, what the heck is going on? Mortgage rates actually went up 1/4%. So if you needed any further convincing that the Fed cuts aren't actually good for mortgage rates, well, here you go. Just look at it. So if you're thinking like, what the heck is going on? You're not alone. And let me actually break it down for you. Let's pull back the curtain on the whole mortgage world here and actually look at it. So here's what's happened. The Fed announced a 1/4 point rate cut today, and the whole industry actually expected this. But the mortgage rates went up 1/4%. So this throws a lot of people off because most folks actually believe that when the Fed cuts rates, mortgages rates will automatically follow suit with them. That's just not true. And here's why. The Fed controls the federal funds rate, which impacts things like your credit cards, your car loans, and short-term borrowing like from bank to bank. Now, mortgage rates, on the other hand, are very closely tied to the bond market and not directly to what the Fed actually does with its moves. So when Jerome Powell, the Fed chair, said he was cutting rates, the market didn't really react to that, but the mortgage market will react to his words, not his actions. And what did Powell say this time? He basically told everyone, hey, we are less likely to cut rates as many times as we did in 24 as we will in 25 because we want to focus on inflation and bringing that down. That statement alone spooked the market. If the market believes inflation will stick around longer, they price that into the cost of a long-term debt like mortgages. That's why rates went up, not down. If rates across the board come down, then people actually spend more money because everything is cheaper. But if rates stay higher for longer, they actually spend less money and inflation actually starts coming down, and it's actually better for the economy. And that is solely the Fed's focus right now, is bettering the economy. All right, so how does this affect the buyers out there? Well, in a weird way, it actually could be an opportunity. When rates go up, demand actually comes down. There's less buyers out there. With fewer buyers means less competition for you. If you are already pre-approved or looking at pre-approved, you have a solid budget, you can afford the home, and you're tired of renting, now might be the time to actually make your move. Use this to your advantage. Get a great real estate agent. I can actually introduce you to plenty of them and let them negotiate hard for you. Sellers are more willing to make deals when there's actually buyer demand is low. Now, let's talk about sellers. Look, if you're a seller, you need to reset your expectations. Gone are the days of the 20, 30 buyers lining up outside of your house. With fewer buyers in the market, you'll actually probably see fewer offers and then less competition. But that doesn't mean you're out of luck, right? It just means you need to work with a smart and skilled real estate agent and then be ready to listen to their advice. Pricing your home right at first matters more than ever. So here's the bottom line. The Fed cut the Fed rate, and mortgages rates actually went up because of what the Fed said, not what they did. Because the market reacts to their message, not their actions. For buyers, this could mean less competition, and for sellers, it actually means being ready to adjust your strategy out